What is up, YouTube? This is the Working Investor. I wanted to give you guys an update on how the sandwiches are going. As you guys know, I have 3 sandwiches in the Yield Max ETFs. When I say sandwiches, I'm talking about I have the high yield dividend ETF funds that are synthetic cover calls. And I also have the inverse of it, which is a synthetic covered puts, essentially having a synthetic covered strangle, so to say. So from the 6 funds that I have, basically I have 3 entities and each one has an inverse. So it's 6 pieces that have, are one whole. So I have the NVDY dips, I have the CONY FIAT, and I have the TSLY from YieldMax. And my split, the way I'm playing it now, it's a 60-40 split, and I put 5,000 into each fund. So with the NVIDIA dips, I started with 5,000 and I added up how much their value is right now, and it's 47.63. That means I'm down in my net asset value between the 2 parts of the sum by $237. And that means I'm down about 4.47%. I wanted to look at today, 9/6/2024, because, I would imagine that the dividend's already been taken out because it's already past, it's like ex-dividend, it's already past ex-dividend date. So it gives me a better picture. But if I held NVIDIA by itself when I entered, I would be down 12.52%. So by having the hedge of dips, I'm only down about 1/3 of what I would have been down had I not had the hedge. So it did help me in that inverse to hold it. Next, we're going to talk about CONY FIAT. So again, started off with $5,000. Right now, when I added them up together, my value of both of them together is $46.20. So I'm down $380, which equates to 7.6% down. Had I held CONY by itself, I would have been down 25%, because I am down right now. In CONY in itself, I'm down 25% in the position. But when I add the CONY and FIAT together, which is the inverse, it's supposed to help as, and again, 40% FIAT, 60% CONY, I'm only down 7.6%. So I'm down less than 1/3 than I would have been had I not had the inverse to protect me. My NAV is more stable. With TSLY, I started with $5,000 in these positions, and adding them up together, it's worth $4,722. I'm down $278. Now this is the craziness. So I'm down 5.5%. But right now, TSLY in itself, in my position, I'm only down 3.5%. So for whatever reason, it's not really working out that this TSLY, the sandwich, I'm down more than if I would have just held TSLY by itself. This is just looking at 1 month, 1 spec in time. So total down is $895. So from the $15,000 investment, I managed to successfully lose $895. I wouldn't call that successful, but whatever, or 5.9%. But then I calculated all the dividends, because YieldMax obviously just came out. They have their dividends. So I added how many shares I have. Like with Fiat, it's $1.87 per share, and we'll go down the list. Whatever, you get the point. So I just added up all the dividends, like TSLY, 81 cents, NVIDY, $1.35. Basically added up the dividends times how many shares I have, so I have an idea. And the bottom line is that my dividends, my loss is $895 in NAV right now. And that's with the inverses. My dividends expected is just from, these are not all of my dividends. This is the dividends from the sandwiches itself, is $972.88, which gives me a net amazing return, guys, of $77.88. If you divide $77.88 by $15,000 and you multiply by 12, it comes out to be a grand total of 6.2% annualized return on a total return basis. Whoopie-doo. And you have to also factor in the taxes. Now, when you consider taxes on $972.88, I think that would counteract the $72.88 gain. So I probably am right now at a net loss. So that's if I reinvest the sandwiches. So I'm trying to think what to do. If I should close the sandwiches completely and just walk away with this little $77.88, or continue on the experiment with the sandwiches. But then I'm trying to think if I should reinvest the divvies into all the sandwiches to get the dollar cost average down, or just, but the whole point of the sandwiches is to try to keep NAV stable, not not down 5.9%. That's the whole point of the sandwiches. And then you could reallocate, actually use the money and use it for other ventures. That was the whole point of the sandwich. So you can keep this, so you can have one hedge against the other. It is a little too soon to come to conclusions, because you also have to bear in mind, all the underlyings besides market conditions dropped by the dividend distribution amount. So it is understandable that if a dividend payouts together will be $895, I would expect all of the underlyings together would drop by $895. And maybe you could think of it that, I'm sorry, it's $972.88. So because the dividends payout is $972.88, I would expect everything to drop by the payout of $970.88. Given that we're so close to ex-dividend date, we're just past ex-dividend date, and it's only down less than that, does that mean that the sandwiches are working? And maybe it's too soon to judge the sandwiches, because I think, maybe just keep the dividends on the side somewhere and see what happens with the sandwiches. See if they recover as a collective, and see how long it takes to recover. And let's see if they recover before the dividend cycle. So one way to look at it, it's bad. Another way to look at it was all the underlyings dropped, and you would expect it to drop by the dividend amount. And the fact that it's dropped, the dividend amount is greater than the amount that it's down right now, maybe that's a good way of looking at it. That's kind of where maybe I'm leaning at. What do you guys think? Again, I'm not a financial advisor. I'm just a person on YouTube running an experiment with my own money for your entertainment. This is The Working Investor, over and out. I hope you guys enjoy. Have a wonderful day.